Good evening, students. Welcome to the session. I hope you have revised the last class. Good evening, Geeta. Yes, so what did we discuss in the last class? Just to give a quick recap, we were discussing about different instruments on that, how the capital gain is being considered, right? So which kind of instruments did we witness? We saw the ESOPs. On ESOPs, there will be the taxability in two legs. One will be when the ESOPs are granted on the date of exercise, when the ESOPs are exercised. So on the date of exercise, there will be the perquisite taxation in the hands of the employee. The ESOPs exercised would be treated as the perquisite, which is the perquisite under section 17 is going to be the fair market value minus the exercise price paid, right? And when you sell those ESOPs, then in that situation, there will be capital gain, which will be amount received minus the cost of acquisition. So the cost of acquisition will be the fair market value, which is taxed under 17(2)(6). Right. So that was for the ESOPs. Then we also said about the bonus shares. I told you about bonus shares that if they are allotted before 1/4/2001, in that case, you can consider the fair market value as on 1/4/2001 if that is more beneficial. In case they are allotted before 1st February 2018, then in that case, you have to take the higher of the fair market value prior to 1/4/2001 or the nil amount, whatever is beneficial, or the FMV as on 31st January 2018 and the sale consideration, whichever is lower, and the higher of the nil or that particular amount, which is the fair market value or sale consideration out of that. And if it is allotted after 1 February 18, then it is nil. Then I also told you about rights issue. If you get a right to subscribe, and in case you renounce that right, then it will be the FVC, will be the amount received, cost of acquisition will be nil. And the period of holding will be from the date of offer till the date of renouncing the right. And in case you subscribe, you get the right issue. You get the right shares. So that when you sell those shares, then it will be the cost will be the amount paid to acquire those shares. Now, the person who has purchased the renounced right, if he exercises, then in that particular case, for him, the cost will be the price paid for purchasing the renounced rights plus the cost of the share. So that is what you will be considering for the rights issue. And then we also did section 50, which is a new section for the market-linked debentures, which is 50AA. In that case, I told you what is a market-linked debenture, where the returns are linked to the market returns on the underlying security or a specified mutual fund, where less than 35% of proceeds are invested in equity shares of company. And if these are acquired after 1/4/2023, the transfer or redemption or maturity will be deemed to be the short-term capital gain chargeable to tax under section 50AA. And what will be the taxability? FPC minus cost of acquisition. But that will be deemed to be the short-term capital gains, right? Then we discussed about the reorganization aspect. Also we discussed about what will be the cost of acquisition for the intangibles. It will be nil. For the intangible goodwill, trademark, or any intangible that is being self-generated. So for that, the cost of acquisition will be nil. Also, then we discussed about the case where, let's say, for example, if I have inherited the property and I am repaying the loan, which was, let's say, taken by my taken by the person from whom I inherited the property. In that case, if I repay the loan, that loan repayment will also be considered as the cost as per the Supreme Court decision in RM Arunachalam. But if I have only taken the loan and I am only repaying it, then it will not be considered in the cost as per the decision of VSMR Jagdish Chandran, right? Now, then we discussed about the reorganization. The first one was the transfer of capital asset by a wholly company to a wholly owned subsidiary or a vice versa. The condition is that the recipient should be Indian company. Then in that particular case, it will not be considered as transfer under 47(4) and 47(5). Also, it will not be taxable in the hands of the recipient under 56(2)(10). But the condition is that the subsidiary should be wholly owned and the recipient should be Indian company. The additional conditions are the recipient shall not convert the capital assets into the stock in trade and subsidiary should not cease to be a wholly owned subsidiary. Both the conditions are to be fulfilled. Let's say, for example, if subsidiary ceases to be a wholly owned subsidiary, then the fair market value as on the date of transfer shall be considered as the full value of consideration, and in that particular case the capital gain will be chargeable in the hands of the recipient company, right? Then what will be happen in the hands of the company which is transferring? In that company's hand, the capital gain will be chargeable in the year in which the conditions are violated. Now, when the subsidiary which has purchased the asset, that asset, what will be the cost of that asset? The cost paid to acquire the asset, that will be considered as the cost. If the conditions are violated, then this will be under section 47A. If the conditions are not violated and if there is exemption under 47.4 and 47.5, what will be my cost of acquisition? The cost of acquisition will be the cost to the previous owner. But if the conditions are violated, in that particular case, you will have the cost, which is the cost of purchase of that capital asset, right? In case the subsidiary converts it into the stock in trade, if it converts the capital asset into stock in trade within the period of 8 years, then in that particular case, again 47A will get attracted. And in that case, what will happen is, in that case, the 47A says that in the year in which the conditions are not complied, then the exemption granted earlier shall be revoked. So the transferor shall be chargeable to capital gains on the transfer of a capital asset in the year in which transfer took place. So again, there will be two components when there is the condition which is violated, the capital asset is converted into stock in trade. In that case, 47A will get triggered, which says what? 47A says what? That the full value of consideration minus the indexed cost of acquisition, that will be considered as my capital gain in the hands of the transferor company. In the hands of the company which is receiving it, in that company's hand, there will also be the taxability under section 45(2). There will be taxability under 45(2), right? So first there will be taxability in the hands of the transferor company, then there will be taxability in the hands of the transferee company under section 45(2). Under 45(2), when the conversion take place, whether in that year the taxability will be arising, answer is no. When the stock in trade is sold. But what will be my FVC? FVC will be the FMV as on the date of the conversion, and minus the cost of acquisition. Also, there will be PGBP on the sale of the stock. Yes, are we clear about this? And then finally, we did the amalgamation. Yes, so there will be taxability in two aspects. Yes, in one case, there will be the, when the capital asset, you can just write down here in this point itself, when the capital asset is converted into stock in trade, this is, you can write down, in the hands of a recipient company. This will be the effect. But this will be the effect in the hands of the transferor company. So this is impact 1 and this is impact 2. Okay, so FBC will be FMV if no consideration is received, or whatever consideration will be received, that is going to be the FBC. So that is what 47A mandates. Okay, is it clear? Then we discussed about the amalgamation. Amalgamation is defined under section 21B. Amalgamation is defined under 21B. And what is the definition of amalgamation, students? Yes, what did we discuss? What is the definition of amalgamation? Yes, Pastor. Yes. What is the definition of amalgamation, students? The amalgamation says that all the property immediately before amalgamation becomes the property of the company, After the amalgamation, all the assets, all the liabilities, and shareholders not less than 75% become the shareholders in the amalgamated company. In the amalgamated company, and in that particular case, there will be the amalgamation conditions which will be satisfied. Are we clear? Yes. Secondly, then what is the exemption? In case there are two exemptions under amalgamation. One is under 47(6), when a capital asset is transferred by the amalgamating company to the amalgamated company, and when the shareholders are extinguishing their rights in the amalgamating company, they are receiving in consideration the shares of the amalgamated company. Now, both these transfers are not taxable under 47(6) and 47(7). Also, for the recipients, there will be no taxability under 56 to 10. All right. And what will be the cost of acquisition for the amalgamated company? For the capital asset which it has received, it will be the cost to the previous owner. The indexation will be applicable from that year of the previous owner. Also, clubbing of period of holding will also be applicable, right? But for the shareholders, when they are receiving the shares of the amalgamated company, again for them, what will be the cost of acquisition? The cost of acquisition will be the cost of the shares of the amalgamating company. The period of holding will also be considered from the period when they held the shares of the amalgamating company. And accordingly, the indexation will also apply. But if they are receiving any consideration in cash, that will be taxable under 45. Okay. That shall be taxable. Also, for the indirect transfer and the transfer of the capital asset, which is consisting of the shares in the Indian company by one foreign company amalgamating with another foreign company, that is also exempt under 47. But the condition is at least 25% of the shareholders of the amalgamating company remain the shareholders of amalgamated company, and such transfer does not attract capital gain tax in the foreign country. Right? So are we clear up to this much? And then now we will start with the demerger. But first tell me, are we clear about this? Yes. Good, Viraj. Good evening, Sailesh. Yes. Fine. Okay. So let's start with the demerger part now. Also, we discussed, remember about the losses under section 72A. The losses freshly will be allowed to the amalgamated company in case the conditions under 72A for the amalgamating and amalgamated company both are followed. That they should be in the same business, they should hold the 3/4 of the book value of the asset, right? And for the amalgamating company, it should also have held the assets for 2 years and should have been engaged in the business for 3 years, right? If these conditions are satisfied, the losses can be carried forward and set off for a fresh period of 8 years by the amalgamated company. Are we clear? Now, next is demerger. Yes, now let's try and understand what is demerger. Yes, so again, demerger is defined. Demerger is defined under the Act. Again, only when the conditions of the demerger are satisfied, then only we can say that this is exempt under the Act. Are we getting that? So the demerger is also defined under the Act. Now, if we look at the definition of demerger, one second. Yeah. If you look at the definition of demerger under the Act, what it tries to say is that in the case of demerger, the conditions are more or less similar to that of the amalgamation only. The conditions are more or less similar to that of the amalgamation only. Now, what it says is basically, under demerger, there is first condition which is in relation to the that all the property of the undertaking being transferred by the demerged company immediately before the demerger should become the property of the resulting company. So as I said, the conditions are more or less similar to that of amalgamation only. So I'll just put up the conditions over here. But first, let's write down what is a demerger. So let's, for example, there is this A company. It transfers an undertaking. Let's say there's AB company. This undertaking is transferred and this becomes, let's say, B Limited. Okay, this becomes, let's say, B Limited. Now, in the case of the demerger, the conditions are defined under section 219 of the Act. 219 of the Act. Okay, and what does it say? Let's look at it. So first is all the property of the company or all the property of the undertaking being transferred by the demerged company before the demerger becomes the property of the resulting company. So all the assets of the undertaking becomes the property of resulting company. So is the case for the liabilities. Are we clear? Now these property and liabilities of the undertaking being transferred by the demerged company are transferred at the book values. So these should not be transferred at the fair market value. Now this condition was not there in the case of amalgamation, but for the demerger this condition exists, that this should be transferred at the book value. So you can write down here. Right? So this should be transferred at the book value. Now the resulting company issues in consideration of the demerger its shares to the shareholders of the demerged company on the proportionate basis. So it will issue the shares to the shareholders. Shareholders holding not less than 3/4 in value, that is 75% shareholders, become shareholders of the resulting company. Are we clear? And the transfer of the undertaking is on a going concern basis. The transfer of the undertaking is on the going concern basis. So it should be transferred on a going concern basis. And lastly, it should be for a genuine business purpose. So all of these conditions, when these are satisfied, it would be resulting in the demerger. Now, what do we understand by an undertaking? The undertaking means the division or unit or a business activity, but not the individual assets and liabilities. So any unit or business division or any business activity which is being transferred as a going concern. Are we clear? So this is the meaning of the demerger. Getting it? Now, once the demerger takes place, what is the effect? The undertaking is getting transferred. Now, what do we understand by the undertaking? Is the only undertaking getting transferred? Answer is no. Here, the individual assets which are belonging to that undertaking. So, all the assets and liabilities of that undertaking are getting transferred. So, there is a transfer which is getting attracted, isn't it? But there is an exemption under 47(6)(b). There will be an exemption under section 47(6)(b). Now, what is the exemption under 47(6)(b)? The exemption under 47(6)(b) is simple, that this will not be considered as a transfer. So, not transfer under section 47(6)(b). Are we getting that? Similarly, for the shareholders. Now, if you look at the shareholders also, the shareholders are also losing out their rights in the company because their value is getting reduced by virtue of the transfer of the assets. So in order to compensate the shareholders, these shares of the resulting company are being issued. So first there is transfer of a capital asset by a demerged company to the resulting company, which as I said is not considered as transfer under 47(6)(b). Secondly, as I said, there is transfer or issue of shares by the resulting company to the shareholders of the demerged company. So in that case, let's say I was a shareholder here. Now I am being issued the shares here. Now this will also not be considered under section 47(6)(d). This also will not be considered as a transfer. Are we getting that? So it is similar as we discussed in the case of the amalgamation. It is very similar, isn't it? So both the leg will not be considered as the transfer. Are we getting that? Similarly, for the purpose of the 56(2)(10) in the hands of the recipient. So 56(2)(10) also will not apply in the hands of the recipient. Section 56(2)(10) not applicable. Here also section 56(2)(10) is not applicable. Are we getting that? Now comes what will be the cost of acquisition of the assets in the hands of the resulting company for the assets that it has got from the demerged company. Now this is going to be little different from the amalgamation. Now in the amalgamation, there was a difference that whatever the cost of acquisition was there in the hands of the amalgamating company will be the cost of acquisition for the amalgamated company. Are we getting that? So in case it's a depreciable asset, so whatever WDV is there, that will be the WDV for the amalgamated company. But the cost of the asset in the hands of the resulting company will now be different. And that in the hands of the demerged company. So how will you take it into consideration? So the section 49 here is going to be applicable for the purpose of defining the cost. What is going to be my cost of acquisition? Isn't it? So the cost of acquisition for the shares also for the shareholders will be a different. So in the amalgamation, what was the cost of acquisition? For the shares which you have acquired in the amalgamated company, it was the cost of acquisition of the amalgamating company. Isn't it? But here, there will be a little difference. So, basically, here what you have to take into consideration is, especially for the depreciable asset. So, cost of acquisition of depreciable asset in the hands of resulting company and demerged company. Now this is my demerged company and this is my resulting company. If you remember, I have discussed that with you while we were discussing the depreciation under section 43. What did we discuss? What will be the cost for the resulting company? So where in demerger, a capital asset is transferred by the demerged company to the resulting company. What will be the cost of acquisition? Yes. Yes, students, we have discussed it faster. What did we discuss? Let me see who remembers. Yes, students, faster. I'm not getting answers. Yes, Mohammed. Prerna, the question is that what will be the cost of acquisition of the capital asset? Yes, in the hands of the resulting company. Faster. We have already discussed that in the PGPP class. Yes. Faster. No, Geeta, not in proportion. That's not correct. Go back to your PGPP notes. What it is written. Yes. So, if you remember, section 43 provides that for the purpose of the depreciable asset, okay, the actual cost which is going to be there in the hands of the demerged company will be the cost to the the actual cost in the hands of the resulting company will be the cost in the hands of the demerged company. Similarly, for the WDV also, the WDV in the hands of the demerged company will become the WDV in the hands of the resulting company. Are we getting that? So basically, in this particular case, the cost of acquisition would be same as that in the hands of the demerged company. Getting it? So write down here. Just write it over here. That the cost of acquisition actual cost of asset in the hands of the merged company. And in case of WDV, it will be WDV in the hands of the merged company. What about the resulting company? What about the demerged company? See, in the case of amalgamation, the company closes off. The amalgamating company just closes. It merges with the amalgamated company. But in the case of demerger, both the entities exist, the demerged as well as the resulting company. Now, what will be the WDV in the hands of the demerged company? For the asset, actual cost, it's fine. Actual cost is of the asset is not only going into the block, it is purchased in that year. So the asset which is purchased is getting transferred along with the undertaking. So then there is no question that there will be any cost in the demerged company. It has not only gone into the block, but the block of asset where I'm talking about the WDV. How will you calculate the WDV of the demerged company? Yes, students. Yes, faster. Yes. So in this particular case, you can just write it over here. This is for block of assets. Correct? In the hands of the demerged company, it will be the WDV. It will be the WDV of the assets which are there minus the WDV of assets transferred to the resulting company. So WDV of assets as on 1st April less WDV of assets transferred to the resulting company. Now that shall be my WDV for the purpose of calculating the depreciation in the hands of the demerged company. Are we clear getting that? And how will you calculate the depreciation? How will you calculate the depreciation? Now for a non-depreciable asset, yes, there is no provision under 49(1) like there is in the case of amalgamation. There is a provision under 49(1) that for the cost of acquisition of a capital asset in the hands of the amalgamated company will be the cost in the hands of the amalgamating company. That similar provision does not exist in 49(1). So that means what? The cost of acquisition can be taken as the book value of the assets which are transferred to the resulting company. Because all the assets, what does section 219 AA says when it defines demerger? That all the assets of the undertaking should be transferred at the book value. So meaning I will consider the book value of the assets only as the cost for a non-depreciable asset. So for a non-depreciable asset, you can write down no provision under section 49. However, section 219 AA provides all assets to be transferred at book value. Therefore, book value of assets shall be the cost of acquisition. Yes. Now, how will you calculate the depreciation? Yes. How will you calculate the depreciation? Yes, students. How will you calculate the depreciation? So, you have not revised the PGBP. Yes, Prerna, correct. In proportion to the number of days. So, the depreciation to be charged proportionately based on number of days assets used. So yes, definitely the depreciation which will be there under section 32 will be charged as in the case of amalgamation also on the basis of number of days the asset has been used. Are we clear? So in the case of the demerger and in the case of the amalgamation, the depreciation will be apportioned between the predecessor and the successor or the amalgamating or the demerged company and the resulting company in the ratio of number of days for which the assets have been used by them. Clear? Now this is about the company, the capital asset which is transferred. Now in the hands of the shareholder, in the hands of the shareholder. This is in the hands of the company. This is in the hands of company. In the hands of the shareholder, what will be the taxability? So, cost of acquisition of shares. Now, in the case of the demerged company, what will be the cost of acquisition of shares of the demerged company and for the resulting company? So again, we go back to section 49. Section 49 gives you the answer for that. So for the cost of acquisition of the shares in the hands of the shareholder, the cost of acquisition of which shares? The cost of acquisition of the shares of the demerged company and the resulting company. First, we'll look at the cost of shares in the resulting company. So this will be the cost of shares in demerged company into the net book value of assets into the net book value of the assets transferred net book value of the assets transferred to the resulting company divided by net book value of assets of, or you can write net book value of total assets before demerger. Now this will be my cost of acquisition of the shares of the resulting company. Okay, are we getting that? So net book value of the assets transferred to the resulting company divided by the total net worth of the demerged company, not the net book value. You should write your net worth. Just correct it. Net worth of the demerged company. Net worth of the demerged company. So that is how you will come to the cost of acquisition of the shares of the resulting company. Now, what is net worth? What do we understand by the net worth? The net worth here means, just write down, net worth here means the paid up share capital plus the general reserves. Net worth means the paid up capital plus general reserves paid up share capital plus my general reserves. Are we getting that? So this is going to be my net worth. And this is as per section 49(2)(c). This is the section 49(2)(c). Yes, are we clear? So in the case of demerger, the cost of acquisition of the shares of the resulting company will be arrived in this particular manner, which is the net book value of the assets transferred. The cost of acquisition of the shares of the demerged company into net book value of the assets transferred divided by the net worth of the demerged company. So this is going to give you the cost of acquisition of the shares in the demerged, in the resulting company, not the demerged, in the resulting company. Clear? Now, what will be the cost of acquisition of the shares of the demerged company? What will be the cost of acquisition of the shares of the demerged company? Yes. So that is given under section 49(2)(d). That is given under 49(2)(d). And what is that given? So let's just write down over here. Cost of acquisition of shares of demerged company minus cost of acquisition of shares in the resulting company, which is going to be this cost. So the balance cost is going to be the cost of the shares of the demerged company. So this is section 49(2)(d). Yes, is this clear, students? Any question, any doubt? Yes or no? Yes? Yes, students. Have you understood this? Fine. Now, what shall be my period of holding over here? What will be the period of holding of the shares of the resulting company? So, for this purpose, what does section explanation 1 to section 242A says. Now we have to understand that. So explanation 1 to section 242A, whether it provides for the clubbing of the period of holding. So in this case, we need to look into what is the explanation talking about. Now, in the case of the shares of the resulting company, since this is not considered as a transfer, this is not considered as transfer under section 47. For the purpose of the period of holding, the explanation 1 to 242A says that you need to consider the period of holding for which these shares are held. Are we getting that? In the demerged company. So basically, for the purpose of determining the period of holding of the shares of the resulting company, where the shares become the property of the assessee by result of the demerger, the period of the shares held in the demerged company will also be. So here there will be clubbing of period of holding. So include period of holding of shares held in demerged company. Explanation 1 to section 242A. Explanation 1 to section 242A. Again, indexation will also be from the period in which the shares were held in the demerged company, because you are having the period of holding also counted from there. Yes or no, students? Is this clear? Yes. Any questions? Any doubt? Yes or no? Faster. Are we clear? So this is little different from the amalgamation. Yes, Prerna, in here, demerger also we will include the period of holding of the shares of the demerged company. Okay. 47(5) and 47(4). Okay. Yes, what doubt do you have is, yeah, in this particular case, when the additional conditions are revoked and when this is the case where the capital asset is converted into stock in trade. So this is the first case. This is the second scenario. In this case, in the hands of the transferor company, you will have this implication. And the second implication will be in the hands of the recipient company. So you can just write down that in the case of the capital asset which is converted into stock in trade, so this is in the hands of the recipient company. In the hands of the transfer company, this is what is going to be the implication. This. In both the situations. Clear? Okay? Yes. So shall we proceed further? Okay. Now in the case of the demerger, again we have a similar provision as there was in the case of amalgamation when there is a demerger between the foreign companies. So what does it say? So let's say there's one foreign company which is demerging its unit to another foreign company, and the capital asset transferred is shares of Indian company. That is one scenario. The second scenario is in the case of indirect transfer of the asset. So, in the first scenario, there is a demerger wherein the shares of the Indian company are getting transferred by the demerged foreign company to the resulting foreign company. That is one. Second is where the foreign company is transferring the shares to another foreign company. Now the share here is the capital asset is shares of the foreign company, but these shares of foreign company derive value substantially from shares of Indian company. In both these situations, this is not transfer under section 47. This is not considered as transfer under section 47 if what are the conditions? In the amalgamation, the condition was at least 25% of the shareholders become the shareholders of the amalgamated company. Here, the condition which is there is at least 75% shareholders. So, at least 75% of shareholders of demerged company become shareholders of the resulting company. And the second condition is same. Such transfer does not attract the capital gain tax. Clear? Such transfer does not attract the capital gain tax. So that is exempt under 47. Fine? Yes or no? Okay. Now what about the losses of the demerged company for the undertaking which is transferred? Losses of the demerged company. Now in this case, what will happen? Now again understand over here. Section 72A talks about the accumulated loss and unabsorbed depreciation. So you can write here, instead of just losses, write the business loss and unabsorbed depreciation of demerged company relating to the undertaking demerged. Relating to the undertaking demerged. Yes. Now this shall be carried forward and set off in the hands of the resulting company. So this shall be carried forward and set off by the resulting company. But here, unlike amalgamation, here you will not get the new fresh 8 years. In the amalgamation, the losses of the amalgamating company which are getting carried forward to the amalgamated company are allowed for a fresh 8-year period. So let's say, for example, I was in the 5th year. But again, now when I get amalgamated, I will get again fresh 8 years. But in the case of demerger, it will be allowed for the balance 3 years. So this year in the demerger will be carried forward and set off by the resulting company for the remaining period. In the case of the business loss. For unabsorbed depreciation, this can be indefinite. Because any which ways for the unabsorbed depreciation, there is no time limit. This is section 72A. Also, one more important thing, you can write it over here. Unlike amalgamation, there are no conditions for carry forward and set off of losses under demerger. There are no conditions. Remember, for the amalgamation, there was condition of the business condition, the asset holding condition. Here, there is simply no condition like that. Is this clear, students? Yes or no? At least be participative. How would I know whether you have got this correct? Because this is very, very important area. Okay? Yes. Are we clear? Fine. Now some common points in terms of the amalgamation and the demerger. Some expenses where the expenses of the amalgamating company are allowed to the amalgamated company, or for that matter, the expenses which are allowed of the demerged company which are relating to the undertaking to the resulting company. Now, which is a section which provides you the deduction for amalgamation expenses and how much is the deduction allowed? Let me see who remembers. Yes, students. Is there any deduction of the expenditure for the amalgamation and demerger? The deduction of the expenditure. There's a specific deduction of the expenditure for the amalgamation and the demerger. Yes. Which was the section? Even if you don't remember the section number, what was the allowability of the deduction? Yes. PGPP class. Yes, students. Which was the section passed? And what was the deduction which was allowed? Let me see who remembers. We have already done that in PGBP. Yes. Yes, students, faster. Section 35DD. Section 35DD. Yes, I've given you the section number. How much expenditure does it allow? Prerna, it was not 35 ABA. 35 ABA was in respect of the telecom and spectrum licenses. It was for the spectrum and telecom license, Prerna. It is 35DD. Yes, Geeta, very good. 1/5 of the expenses is allowed under 35DD. So, the expenditure relating to the amalgamation and the demerger which are exclusively incurred for the amalgamation or demerger, 1/5 of the expenditure will be allowed for a 5-year period from the previous year in which the amalgamation or demerger takes place. So just write it over here. Here you can write down common points for amalgamation and demerger. Section 35DD allows amortization of expenses incurred wholly and exclusively for amalgamation and demerger. 1/5 of expense over 5 years from year in which amalgamation or demerger takes place. Yes, students? Fine. Then understand one thing. There are certain sections which allow the deduction, balance deduction to the amalgamated company. If the deduction is obtained by the amalgamating company, the deduction for that expense, if the amalgamation happens, is allowed to the amalgamated entity. Which were those provisions that you can think about? Remember, in many of the sections I told you that in case the amalgamation takes place, then these expenses would be allowed to the resulting company in the case of demerger or to the amalgamated company. Which were those expenses? Let me see if anybody can recollect. Whatever you can recollect. Yes. Any section that you can recollect. Yes, students. Yes, let me see who can recollect. Which are the expenses which can be carried forward by the amalgamated or the demerged entity? Yes. Faster. Yes, students. Let me see who can answer. Geeta, that is loss and unabsorbed depreciation. That is fine. But there are the expenses which are allowed. Yes. So one example that I'll give you is expenses of amalgamating company or demerged company allowed to allowed to the amalgamated company or resulting company. Scientific research expense under section 35. Allowed only to amalgamated company. That is not allowed to the resulting company. That is only allowed to the amalgamated company. Telecom expense. Deduct, or you can just write down telecom deduction. under 35 ABB. This is allowed to the resulting company as well as to the amalgamated company. Whereas scientific research expense is only allowed to the amalgamated company. Are we getting that? So scientific research is only allowed to the amalgamated company. It is not allowed to a demerged company. But the telecom license which is there, the deduction which is allowed, which is over the period of license, the license fee that you pay, that is allowed to the resulting company as well as to the amalgamated company. Similarly, the preliminary expenses under section 35D. The preliminary expenses under section 35D. Again, that is allowed to both the amalgamated as well as to the resulting company. Amalgamated as well as to the resulting company. The second one is the expenses on the VRS, voluntary retirement scheme, which is again allowed over the 5-year period, right? So again, that is allowed to be amalgamated and resulting companies, right? Preliminary expense under section 35D, VRS expense under section 35DD8. Yes, so these are particularly allowed to the amalgamated or to the resulting company. Are we clear? Yes. Any other expenditure that you can think about? There is one more expenditure that I can recollect. Yes, let me see now who can recollect that. That was under 36. That was under 36. Which was that? Yes. Family planning expense. Under 36(1)(9). So again, that is again allowed to the both resulting and the amalgamated company. Are we getting that? So these are the expense which are allowed to be amalgamated and to the resulting company. Are we clear? Yes or no? Any doubts, students? Any questions? Yes. Is this clear up till this point? Yes or no? Fine. Clear. Any doubt? Any questions? Yes or no, students? Are we clear? Can you just go through it for 1 minute and then we proceed forward? Yes, so that it's crystal clear to you. I'm giving you 1 minute time to just go through it entirely. Okay, fine. Last one point in terms of the amalgamation demerger. If you remember, we had discussed while we were closing the PGBP section 41, wherein I had told you that if the deduction has been claimed and later on there is a remission of the liability or some benefit is obtained, then under 41, that particular amount shall be taxable. Now, if the deduction has been claimed by the predecessor and the waiver has happened in the hands of the successor, there's a remission or the benefit is obtained by the successor, then the successor will be taxed. The successor shall be taxed for that particular amount. So 41(1) says that if the predecessor has obtained the deduction in respect of a loss or expenditure or some benefit in respect of trading liability, he has claimed that deduction, right? And the successor of that business obtains the benefit of in terms of the remission or cessation of that liability, then it shall be deemed to be the PGBP of the successor. So just write down deduction of expense by predecessor but benefit obtained by successor by remission or cessation of liability 41(1) in hands of successor. 41(1) in the hands of the successor. Yes, clear? So basically, what we have done is we have done the amalgamation and the demerger. Both of them are done. For the amalgamation, the condition is all the assets and the liabilities should become the asset and liability of the amalgamated company. 75% of the shareholders of the amalgamating company become the shareholders of the amalgamated company. The capital asset that is transferred by the amalgamating company to the amalgamated company is not a transfer under 47(6). And as far as for the shareholder who is concerned, for him also there will not be any transfer if he receives in consideration the shares of the amalgamated company. If he receives the consideration in cash, there will be taxability. There will not be any 56(2)(10), right, in the hands of the recipient. Now, as far as in the hands of the amalgamated company, what will be the cost of acquisition of the capital asset that is received by them? The cost of the acquisition of capital asset in case of a non-depreciable asset shall be the cost in the hands of the amalgamating company. The period of holding will be clubbed. The indexation will also be applicable from the earlier previous owner's period, which is as per Manjula Shah judgment, right? In the case of the depreciable asset, it will be the WDV in the hands of the amalgamating company. The depreciation will be allocated in both the companies proportionately. In the hands of the shareholder, what will be the cost of acquisition of shares of the amalgamated company? It will be the cost of acquisition of shares of the amalgamating company. Again, period of holding club, Manjula Shah judgment applicable for indexation. When you come to demerger, what are the conditions? All the assets and liabilities are transferred. It should be transferred at the book value. The shareholders should get the shares in the resulting company and 75% of the shareholders should become the shareholders of the resulting company. Then, if these conditions are satisfied, the capital asset that is transferred by the demerged company to the resulting company, not transfer under 47, no transfer for the shareholders also. Plus 56(2)(10, not applicable. Now, as far as the resulting company is concerned, what will be the cost of acquisition for the resulting company in case of non-depreciable asset? Book value. For a depreciable asset, it would be the actual cost of asset or the WDV of the asset in case of block of asset. What will be the depreciation? Proportionate depreciation. For the demerged company, what will be the WDV in the case of block of asset? WDV of the assets minus WDV of the assets transferred to the resulting company in the demerger. For the shareholder, what will be the cost of acquisition of the asset of the cost of acquisition of the share of the resulting company? Cost of the shares of the demerged company into net book value of the assets transferred divided by net worth. Net worth is the paid up capital plus the general reserve. For the demerged company's shares, what will be their cost? Cost of the shares minus the cost of shares of resulting. What will be the period of holding of the demerged period of holding of the resulting company? Period of holding will be clubbed. Indexation, Manjula Shah applicable. As far as the set of losses and carry forward of losses is concerned, in the case of amalgamation, you can carry forward and set off the business losses for a period of fresh 8 years. Unabsorbed depreciation indefinitely. But there are conditions that the assets should have been held by the amalgamating company for more than 3 years. Business should have been carried on for more than 3 years. Assets, 3/4 of the value of assets for more than 2 years. In the case of amalgamated company, the business should be carried forward for 8-year period. Sorry, 5-year period. The assets should 3/4 of the value of assets should again be held by 3-year period. So these are the conditions. In the case of demerger, you can carry forward the losses and depreciation for the balance period. Depreciation indefinitely, business loss for the balance period. No conditions there. Are we clear? Yes or no? Okay. So we have completed the transfer of capital asset by the holding to subsidiary and vice versa. We have completed the amalgamation and demerger. Now, next that we will move on is the conversion of the sole proprietary concern to a company, conversion of a firm to a company, and conversion of company to the LLP. Okay? And then finally, we will have the slump sale. And that will finish your reorganization. But let's take a small break of 10 minutes before we move on to the next topic. Otherwise, it will stretch then. So we will not be able to then take a break in between. So let's take a break of 10 minutes and then we get back. Okay? Let's take a break of 10 minutes. proceed, students. As I said, now we are going to discuss the conversion of sole proprietary concern to the company or conversion of firm to company or conversion of company to the LLP. So we are going to discuss all of this together because most of their conditions are same. Fine. So that's what we are going to now start. Are you with me? Yes or no? Yes. Okay. So basically, in the case of the conversion of the sole proprietary concern to the company, what happens is, or conversion of firm to the company, there is a transfer of capital asset by the sole proprietary concern to the company or by the firm to the company or by the company to the LLP. In all these cases, there will be the capital asset which will get transferred. Now that is not a taxable transfer. So there is the exemption provided under section 47. So 47 says what? The transfer of capital asset in the case of the conversion of the sole proprietary concern to a company or the conversion of the firm to a company or for that matter the conversion by a company to the LLP. Are we getting that? In all these cases, there will not be any transfer under section 47. So just write down not a transfer under section 47. Getting it? But there are conditions attached to it. There are conditions attached to it. And what are the conditions that we have to see? So in all the three cases, like in the case of the amalgamation, demerger, there are conditions attached. So all these are the conditional exemptions that you get. Only when you fulfill these conditions, only then this will not be considered as a transfer. Only in that situation, this will not be considered as a transfer. Correct? So what are the conditions? Just write down. First, I'm writing here for the sole proprietary concern to company. Then this is firm to company. And last one is company to LLP. Right? Okay. One second. Give me a minute. Fine. Okay. So basically, in these three buckets, I'm trying to bifurcate. So first condition in the case of sole proprietary concern to the company. What are the conditions that are given out? All the assets and liabilities of the sole proprietor become the assets and liabilities of the company. So, all assets and liabilities are transferred. The second condition is the shareholding of the sole proprietor in the company remains more than 50%. So the sole proprietor should have the more than 50% of the voting power for a period of 5 years. So sole proprietor having not less than, or just write down, more than 50% of voting power for 5 years. So he should have that shareholding for the 5 years from succession. Does not get, the sole proprietor should not get any benefit from company other than issue of shares. So the sole proprietor should not receive any consideration other than by way of the allotment of shares. If these conditions are satisfied, you will have the exemption under section 47(4). Otherwise, you will not get any exemption. So when these specifically the conditions will be satisfied, only then you will get the exemption under section 47(40). Are we clear? Yes or no? So this is the conversion of the sole proprietary concern to the company. That is number one. The second one is the conversion of the firm to the company. The second one is the conversion of the firm to the company. Now, what is that? So just write down what are the conditions. All the assets and liabilities of the firm will become the assets and liabilities of the company. So just write down. All the assets and liabilities, same condition, are transferred. So all the assets and liabilities should get transferred by the firm to the company. All the partners of the firm should become the shareholders of the company in the same proportion in which their capital accounts stood in the books of the firm. So, all the partners become shareholders of company in the same capital ratio. So all the partners should become the shareholders of the company in the same proportion in which they held the shares, held the capital basically. Are we getting that? Then in the case of the firm, the partners should not receive any benefit other than by way of the allotment of the shares. So, the partners should not get any other benefit other than by way of the allotment of the shares. So, just write down. No benefit partners other than by way of allotment of shares. Then, what is the next point? The shareholding in the company of the partners is not less than 50% of the voting power. And that should be for a period of 5 years. So, shareholding not less than 50% in company of the partners for 5 years. So all of the conditions are same, except here there's one condition that all the partners should become the shareholders of the company. Then in that particular case, what will happen is there will not be any capital gain under section 47. Fine. So this is conversion of the partnership firm to a company. Next is conversion of the company to the LLP. Now here you have certain additional conditions, which is also very, very important. So write down. The first condition is that all the assets and liabilities before the conversion become the assets and liabilities of LLP. So all assets and liabilities are transferred from the company to the LLP. Second, all the shareholders become the partners. All shareholders should become partners in the LLP, and their capital contribution and PSR should be in the same proportion as their shareholding. And their capital contribution and PSR should be in same ratio of shareholding. Third, the shareholders should not receive any consideration other than the profit and capital contribution. No consideration other than capital contribution and profits, profit share. Next, the PSR of the shareholders shall not be less than 50% for the 5-year period. Profit sharing ratio greater than 50% for 5 years. Are we getting that? Next 3 conditions are the additional conditions over here. One is the total sales or turnover or the gross receipts of the company in the 3 preceding previous year, in any of the 3 preceding previous year, shall be 3 previous years less than rupees 60 lakh. It shall be less than rupees 60 lakh. And next is the total value of assets. Total value of assets, or let me write it over here, total book value of assets. Book value of assets shall be less than rupees 5 crores in any of 3 previous years, less than rupees 5 crores. So let's say in 1 year it is 1 CR, in the next year it is 10 CR, in the third year it is 4 CR. Condition is violated. In all the 3 years, it should be less than 5 years, 5 CR. Similarly for the sale. Finally, no consideration paid to shareholders. No consideration is paid to the shareholders. Oh, sorry, to any partners, not shareholders, to partners. No consideration is paid to the partners out of the accumulated profits. Out of the accumulated profits on the date of conversion. So for a period of 3 years from the date of conversion, no amount should be paid out of the accumulated balance which is transferred to the LLP for 3 years from conversion. So all of these conditions shall be satisfied in the case of conversion of the company to the LLP. So there are 2 additional conditions over here. One is 3 additional conditions. Total sales should be less than 60 lakh in all of the 3 previous years. Then the book value of the asset should be less than 5 crores in all of the 3 years. And no amount should be paid to the partner out of the balance of the accumulated profit from the 3 years from the date of conversion. Are we getting that? Now, in case the conditions are violated, what if the conditions are violated? So, 47A will become applicable. So, where any of the conditions which are violated under 4713 or 4714. So, 4713 is the conversion of a firm to a company. And 4714 is conversion of sole proprietary concern to a company. Now, in both of these cases where any condition is not complied with, then the capital gain which is arising, which has been exempted, will be deemed to be the profit and gains, will be deemed to be the capital gain of the successor company where the conditions are violated. So just write down. Violation of condition. Violation of condition. Sorry. One second. Violation of conditions. So, capital gains exempted earlier taxable in the hands of successor company in the previous year of violation. Now this is for the company. This is for the company. For the conversion of firm to the company or sole proprietary to the company. Where the conditions are violated, in case where a company is converted to LLP, then the capital gain which is arising, which has been exempted, again shall be deemed to be the capital gain of either the LLP or the shareholders of the company in the year in which the requirements are not complied. So, in the case of the violation of the conditions which are there for conversion of the sole proprietary or a firm to a company, then in that case, the capital gain which has been exempted earlier will be taxable in the hands of the successor company in the previous year in which the violation takes place. What will be my capital gain? Capital gain will be again the fair market value of assets on the date of conversion minus the cost of acquisition. So what will be the capital gain over here? Capital gain will be FMV on date of conversion minus the cost of acquisition. This shall be my capital gain. This shall be chargeable in the previous year in which the violation takes place. Whereas in a case where the conversion of company to LLP conditions are not satisfied, then the capital gain will become the capital gain of the either LLP or of the shareholder of the predecessor company in the year in which the non-compliance takes place. So just write it over here. Capital gain exempted earlier, taxable in the hands of LLP or the shareholders in the previous year of violation. This is under section 47A. This is under section 47A. Yes, students, is it clear? Yes? Yes or no? Any questions? Any doubt as such? Yes? Okay. So in case the conditions are violated, then in that particular case, there will be taxability in the hands of the successor. Yes? Any questions? Any doubt? Yes or no? Any question? And in the case of, yes, the LLP, when it is conversion of the company to the LLP, if the conditions are violated, then the capital gain exemption to the predecessor company will be the capital gain of the LLP plus the amount of exemption which is given to the shareholders will also become the capital gain of the shareholders of the predecessor company. Clear? So that is under 47A. Clear? So basically, for the company, the capital gain exempted earlier, there are two capital gain which are getting exempted in the case of conversion of company to LLP. One is there is transfer of capital asset. Second, there is transfer of shares. So both will get taxed over here. Both will get taxed. In the case of sole proprietary, see there is no transfer which is happening. There is only transfer of capital asset which is happening. Sole proprietor is same as a sole proprietary concern. In the case of the partnership firm also, there is the just transfer of the assets which is happening. So, in that case, we can just tax the capital gain exempted in the hands of the successor. But here, the capital gain exempted earlier, you can write it over here. Just make a small correction over here. Capital gain exempted earlier on transfer of, make it like this. So let's just simplify. capital gain exempted earlier on transfer of capital asset taxable in hands of LLP in previous year of violation of conditions, capital gain exempted on transfer of shares taxable in hands of shareholders in the previous year of violation. So this is 1, this is 2. Yes. Any questions, any doubt? Are we clear up till this point? Yes. Okay. Fine. Now again, there are certain common points with respect to this, which I would like to discuss. Now, first of all, understand what will be the cost of acquisition of the asset that the successor company or the successor LLP gets. What will be the cost of acquisition? So where there is any transfer of capital asset, right, by the proprietor to company, firm to company, or a company to LLP. So what will be my cost? The cost of the capital asset will be obviously the cost to the previous owner. Of course, then the period of holding will also be clubbed, as well as the indexation will also be of the previous owner, from the previous owner's date. So there will be the Manjula Shah judgment becoming applicable. Are we clear? So just write down. Cost of acquisition of capital asset transferred. This will be the cost to previous owner. Period of holding include period of holding of previous owner. Explanation 1 to section 242A and indexation Manjula Shah applicable. So Manjula Shah case here will be applicable. Fine. Clear? So the cost will be the cost to the previous owner. And that is how you will even include the basically the period of holding as well as the indexation. Are we getting that? Now, for the shareholders who are receiving the shares, so rights which are received in a firm by the shareholders on conversion of private limited company into LLP. Similarly, when the shareholders are getting the capital asset, which is the shares. Sorry, the partners are getting the capital asset, which is the shares. So in that case, how will you calculate the cost in that particular situation? So first of all, talking about the rights received in a firm by the shareholders on conversion of the company into LLP. The cost of acquisition of such rights will be the cost of the shares. So the cost of acquisition of the rights will be the cost of the shares. So just write down. This is for the successor. In the case of cost of acquisition of rights in LLP. In this third situation, it shall be the cost of acquisition of the shares. Cost of the rights in the LLP shall be cost of the shares. Are we getting that? So when there is transfer of capital asset, when these conditions are satisfied, in that particular case, what will happen? What will be the cost of the acquisition of the membership rights that you are getting in the company? In the, partnership form. So in that case, it shall be the cost of the shares. That is also as per section 49. That is also as per section 49. Clear? Yes or no? And for the shareholders who are getting the rights in the LLP, what about the members, the partners who are getting the, who are becoming the shareholders in the company? What will be the cost of acquisition of the shares? The cost of acquisition of the shares will be again the cost which they have paid as the capital contribution. Are we getting that? So even in case where the partners become the shareholders, where the partners become the shareholders, in that case, what will be my cost of acquisition? The cost of acquisition shall be the cost which is incurred for the capital. So that will become my cost of acquisition. So just write down. Just write over here the cost of capital. Cost of acquisition of shares. This shall be my capital contribution. Yes or no? This shall be my capital contribution. Clear? Any doubt? Any question till now? Yes. So in both these situations, there will be the cost to the previous owner. Now, what about the period of holding? What will be my period of holding? Yes. Give me the answer. What will be my period of holding? Yes, faster. What will be my period of holding? Yes. Yes, students, what will be the period of holding here for the shares? So the period of holding for the shares, basically see, in the case of when the shares are allotted. Now the shares are allotted based on the conversion of the firm or the conversion of the proprietary concern. Now in these situations, the shares are the new assets that you are getting, right? Here, whether the period of holding of the, let's see, sole proprietor would be just same as his concern. So in that case, whether you will club the period of holding, whether there is anything to club particularly, yes, yes. Tell me the answer. So here, it is not possible to club because what you are getting is the shares to the partners or the sole proprietor. So here, the period of holding will be from the period from which the shares are allotted. From the period from which the shares are allotted to. So just write it over here. Period of holding. There is no particular provision under explanation 1 to section 242A. From when shares allotted. Yes, for the sole proprietary concern, there will not be any capital contribution per se. So here it will be the value at which shares are allotted. That will be my cost of acquisition of shares for the sole proprietor. Okay. What about the company converting to LLP? For them, what would be the period of holding? Yes. What will be the period of holding? What will be the period of holding for the LLP? Again, under 242A, there is no clubbing of the period of holding which is given in the case where the company is converted to an LLP. So again, in that particular case, there is no period of holding clubbing concept which is given. But for that purpose, if you look at section 49, if you look at section 49, one important point which you notice that the cost of acquisition is not as per 49(1). The cost of acquisition of the shares, cost of acquisition of the membership right is not as per 49(1). So you cannot just say that the clubbing of the period of holding is applicable. That is not applicable over here. Because clubbing of period of holding will happen only in cases where a specific instance is given under explanation 1 or the cost is taken as per 49(1). When the company is converted to LLP, when a company is particularly converted to the LLP, that is as per 49(2)AA. The cost of the LLP interest will be the cost of the shares that is given in 49(2)AA. That is not given under the 49(1). So you cannot merely say that shall become applicable directly. Are we getting it? So here also there is no particular provision which says that, but still we can consider that since the capital asset which is getting transferred under 47 is covered under 47(13)(b), so therefore the cost should be the cost to the the period of holding should also be clubbed. So the period of holding should ideally also be clubbed. So here I can club the period of holding of the shares included. Period of holding of shares to be included. Okay. So though there is no specific provision per se, but since it is covered under 49(1), the transfer of the shares as well as the transfer of capital asset during the conversion of company to LLP. So then in that particular case, I will cover this under explanation 1 to section 2 further. Clear? Any doubt? Any question? Yes. Any doubt? Yes, students, yes or no? Clear? Yes or no? Clear? Okay. So that is about the conversion of the company to LLP or the LLP, the partnership to the company and the sole proprietary to the company. Now, what are other additional points that I would like to discuss over here? How would the depreciation be allowed? Again, the depreciation will be allowed in the proportionate to the number of days. So the depreciation which will be allowed will be on the basis of the number of days for which the assets are used. Okay. So depreciation in all these cases based on number of days assets are used. That is proportionately allowed to predecessor and successor. Fine. So depreciation will be allowed to the predecessor as well as the successor in the number of days. Okay. Now what will be the cost of the block of assets. What shall be the cost of the block of asset? So again, it shall be the written down value to the predecessor. It shall be the written down value to the predecessor. So just write down the cost of acquisition for block of assets, WDV of predecessor. So same that we discussed during the amalgamation, same points are applicable over here. In case of the depreciation as well as in the case of the block of assets. So whenever you are converting, the depreciation on the conversion will be allowed on the proportionate basis. Also, in the case where there is succession, in that case also, what will happen in case of the succession? The written down value of the predecessor will be taken to be the written down value of the successor. Clear? Also where the block of assets are transferred by the private limited company to LLP and the conditions are satisfied, then the block of assets of the LLP will be the written down value of the company. Clear? So that is something which is clearly given. Fine. Next important point which is there is what will happen in respect of the accumulated loss and the unabsorbed depreciation. So the accumulated loss and the unabsorbed depreciation shall be available to the successor. The accumulated loss and the unabsorbed depreciation shall be available to the successor for the balance period. For the balance period that shall be available. So fresh 8 year again will not be given. Fresh 8 years will not be given. So just write down again under 72A, the losses carry forward of business loss and unabsorbed depreciation. So this cost depreciation, this is carry forward of the business loss and the unabsorbed depreciation. So what does 72A provide? 72A provides that the losses will be carried forward in the case where there is reorganization and the conditions are complied under 4713, under 4714 and under 4713B. Then the accumulated loss and the unabsorbed depreciation of the predecessor firm or the proprietary concern shall be deemed to be the loss or the depreciation for the successor company in which from the year in which the reorganization takes place. Are we clear? So just write down carry forward of business loss and UAD allowed by the successor. Similarly, in the case of the conversion of the company to the LLP, again the similar condition is provided. So in that case also the loss which is there or the unabsorbed depreciation of the predecessor company is there shall be deemed to be the loss of the successor LLP. Are we getting that? Clear? And this shall be for fresh 8 years and not for the balance period. This shall be for fresh 8 years. Clear? But if the conditions are violated, if the conditions are not complied with, then the loss which is allowed shall be deemed to be the income in the year in which conditions are not. So, if conditions violated, then loss and UAD allowed earlier deemed to be the income in the previous year in which the violation takes place of the successor in previous year of violation. Yes, clear. Okay, fine. Okay, so let's proceed further. Now, next one is the slump sale. Now, this is very, very important. Now, be attentive over here in the case of slump sale. Now, in the case of slump sale, what is first of all slump sale? Do you know what is slump sale? Yes. What is a slump sale? Now, slump sale is defined under section 242C. Slump sale is defined under section 242C. What is a slump sale? How is it defined? Just write down. Slump sale is defined under section 242C. How is it defined? Slump sale means transfer of one or more undertaking, or just write down transfer of undertaking for a lump sum consideration, transfer of undertaking by any means for a lump sum consideration without values being assigned to individual assets and liabilities. Without values being assigned to individual assets and the liability. So, transfer of one or more undertaking. Transfer meaning as per section 247, which means sale, exchange, transfer means sale, exchange, relinquishment, extinguishment, all of that. So, transfer of undertaking by any means. It could be for a monetary consideration, it can be for a non-monetary consideration. For a lump sum consideration, that is without assigning individual values to the individual asset, the assets and liabilities are taken over for a lump sum consideration. That is a slump sale. It is different from demerger. In the demerger, the undertaking is demerged from that entity. Here only the assets and liabilities are transferred of that undertaking. Demerger is different. Demerger, in that case, you have to comply with 219 AA conditions, which is all the assets and liabilities are transferred. Here, all assets and liabilities may not be transferred. There, the shareholders should get the shares in the resulting company. There's a new company forming in the demerger after the demerger is done, or the unit is demerged into another company. Then the 75% of shareholders should become the shareholders in the resulting company. Here it's not like that. It just says transfer of undertaking for a lump sum consideration without assigning values to the individual assets and liabilities. Now the capital gain arising from the sale of the undertaking by way of a slump sale is dealt under Section 50B of the Income Tax Act. So 50B is again a special provision. See, we have done Section 50A, which is for the depreciable asset. When the depreciable asset is transferred, so in that case, the capital gain can arise only when the block ceases to exist or the sale consideration exceeds the WDV. Then it will be deemed to be a short-term capital gain. We have seen 50AA for the market-linked debentures and specified mutual funds. Again, that is a special provision which says what? The capital gain on sale of or transfer of such mutual funds is short-term capital gain. You have also seen Section 50, which is for what? Power generating units. 50A is for the power generating units, where what is happening? Where a capital asset on which the depreciation is claimed for the power generating units, then in that particular case, you will have the capital gain under 50A when the balancing charge happens under 41. So amount over and above balancing charge is charged under 50A. Again, that's a special provision. Right? Now 50B is for the slump sale. You will see 50C in the coming class. We will see 50CA in the coming class. So these are the special provisions under capital gain. So right now we are focusing on 50B. So what does 50B says? That the capital gain from the slump sale from the long-term capital assets arising from the transfer of a long-term capital asset shall be deemed to be the income in the previous year in which transfer takes place. And for the short-term capital gain, this will also be deemed to be the income in the year in which the capital assets are transferred. Now, what is the period of holding which is given? So, for long-term and short-term, period of holding is 36 months. So, if more than 36 months, it will be long-term. For less than 36 months, it will be short-term. Now, what is the capital gain over here? Or let me just first write what will be my capital gain. So, period of holding I'll write at the end. So, capital gain in this particular case will be the full value of consideration minus the cost of acquisition. Full value of consideration minus the cost of acquisition. So, what will be my capital gain? FVC minus the cost of acquisition. Now, FVC will be higher of FMV1 and FMV2. The FVC shall be higher of FMV1 and FMV2. Now, what is FMV1 and FMV2? Let us try and understand. So, this rules gives us the manner in which the FMV is computed. Rule 11 UAE. Rule 11 UAE gives us that what will be the fair market value or full value of consideration for the 50B. So this is coming through Rule 11 UAB. Oh, sorry, 11 UAE. Now, what is fair market value 1? Fair market value 1 will be A plus B plus C plus D minus L. Now, let's try and understand what is this. What is first? I'll not touch upon A. First, I'll touch upon B. B is the value of jewelry and artistic work. So, first I'm writing B. A I'll write later. B is value of jewelry and artistic work, which shall be open market value, which shall be the open market value. Okay, or on the basis of valuation report. Then what is C? C is the immovable properties value, which shall be my stamp duty value. Then D is the immovable property value. So that is D and not C. C is the value of the shares. C is the value of the shares. One second. So this is the value of shares and securities. This will be as per rule 11 UA. This is what we are going to see later. D is the immovable property. For that, as I said, this is the stamp duty value. Now remains A. A is any other asset. A is the any other asset other than B, C, and D. That is the book value. That is my book value of the asset. Are we clear? Less any income tax paid, reducing book value of asset minus income tax paid plus income tax refund less any deferred expenditure. Right? And what is my L? L is the book value of the liabilities. L is book value of liabilities. But this shall be after reducing or but not including except paid up value or paid up capital, paid up share capital, then dividend, provision for dividend on shares, or proposed dividend, then reserves and surplus, then provision for tax, provision for tax, that will also not be included, right? Then provision for liabilities, provision for liabilities and contingent liabilities. These all are not going to be included. This is my fair market value 1. So fair market value 1 will include the value of all the assets, book value of all the assets minus income tax paid plus income tax refund, any deferred expenditure. B is for the jewelry, which is the open market value. C is for the shares and securities. And D is for the immobile property, which is the stamp duty value. Clear? Now, what will be my FMV2? This is my FMV1. My FMV2 is E plus F plus G plus H. Just write down. FMV2 is E plus F plus G, sorry. Make it bigger. FMV, this is going to be equal to E plus F plus G plus H. Now, what is EFGH? E is cash consideration or any monetary consideration. Cash or monetary consideration. F is going to be the fair market value of the shares. F is going to be the fair market value of the shares or the jewelry which is there. Okay. So just write down. F is going to be again the value of the shares. F is going to be the value of shares, which is again as per rule 11 UA. F is going to be as per rule 11 UA. G is going to be the jewelry and artistic work. So G is the jewelry and artistic work, okay, which is again the open market value, which is again the open market value. So F is going to be the shares, which is rule 11 UA, and G is going to be the jewelry and artistic work, which is the as per open market value. And of course, H is immobile property, which is stamp duty value. So the higher of these two will be considered as the FVC. And these values are to be taken on the date of slump sale. So this is going to give me what? The FVC. The higher of these amount will going to give me the FVC. Now this is FVC. What about my cost of acquisition? As I said, this is the FVC. Then what will be my cost of acquisition? So the cost of acquisition is will be net worth. The cost of acquisition is the net worth of the undertaking. So what do we mean by the net worth? So net worth means the total value, of the assets and the liabilities. So book value of assets minus book value of liabilities. Book value of the assets minus the book value of the liabilities. So here, ignore the revaluation. Ignore the revaluation. Now for the book value of the assets, for the depreciable assets, consider the W. For the depreciable assets, consider WDV. In case of goodwill of business or profession, goodwill of business or profession, book value shall be nil. For scientific research assets used for scientific research for which deduction claimed under section 35 again nil. So not scientific research, assets used for specified business, not scientific research, for the specified business. Assets used for specified business. 35. So again it shall be nil. Fine. Now that shall give you the book value of the assets. That shall give you the book value of the asset. One more important point which you have to remember over here is that for the purpose of calculating the book value of the assets, you have to consider the depreciation. You have to consider the WDV for the depreciable asset. You have to consider the depreciation for the WDV for the depreciable asset. Also, here you have to ignore the revaluation. You have to ignore the revaluation. Fine. Last important point. No indexation will be allowed over here. So, no indexation will be allowed. Fine. So, no indexation. Now, what will be my period of holding? As I said, the period of holding for a long-term capital asset, period of holding greater than 36 months for short-term capital gain or short-term capital asset, period of holding less than equal to 6 months. So for long term, it is more than 36 months. For short term, it is less than equal to 36 months. And the capital gain which is going to be there is going to be taxed on the basis of 20% long term and 10%, normal rates short term. So the tax rate, this is my period of holding. Tax rates, this is 20%. This is normal. Fine. Yes or no, students? Shall we do a small question on this topic, on the slump sale? This is very simple. Yes. Yes or no? Are we clear? Let's do a small question on the slump sale. But are you clear? Let me give you the question then on the slump sale. So let me just give you a question. Let's write down. One second. Let me just put the question only in front of your screen. Okay. So I'm just putting the question in front of you. Are you able to see? Yes. So Nickelodeon and Company, which is there, is engaged in the business of textile manufacturing and footwear manufacturing. Since textile manufacturing is not doing progress, the company decided to transfer the unit 1, which is textile manufacturing, by way of slump sale for total consideration of 14 lakhs. The cash consideration is 10 lakh, land given is of 2 lakhs, the SDV of the land is 6 lakh, plus the shares of rupees 2 lakh, the FMV of which is rupees 4 lakh. The Unit 1 was transferred on 1/4/2022 and was started in 2005 and 6. You are given the assets and the liabilities. You have the share capital, devaluation reserve, bank loan, trade creditors, provision for tax, payables, building, machinery, debtors, patents, IT refund, and shares. Revaluation reserve is created by revising the value of building in Unit 1. The building is carried at WDV before making revaluation. Patents acquired on 1/7/2020 are not depreciated ever. WDV of machinery for Unit 1 is rupees 3.5 lakh. SDV of building for Unit 1 is 15 lakh and Unit 2 is rupees 7 lakh. So, in that particular case, you are required to compute the slump sale valuation and the capital gain accordingly over here. Also, one last point over here is, sorry, the FMV of the shares is 2 lakh and other shares are for, and all the shares are for U1 assumed as per Rule 11 UA. Okay, so just calculate and tell me first what will be your FMV1. What is my FMV1? First of all, just calculate FMV1. Yes. Start calculating. What will be my FMV1? Start calculating, students. First, give me the answer for FMV1. Yes, students, faster. Let's calculate together. How will you calculate FMV1? Just tell me that. Are you there with me? So first of all, if you look at FMV1, what is A plus B plus C plus D minus L? We'll start with B because as I said, the A is the residuary asset. Okay, so just write down FMV1. First of all, my capital gain will be FVC minus cost of acquisition. This is FMV1, FMV2, whichever is higher. So first I am calculating the FVC and in that A, which is the FMV1, which is A plus B plus C plus D minus L. So first I am calculating my B. What did I say for B? B is the value of jewelry. Is there any jewelry in the balance sheet? Answer is no. Sorry, is there any jewelry given? This is the FVC. So is there any jewelry given? Answer is no. So I'm going to take it 0. Then C is the value of the shares. C is the value of the shares. Are there any shares given? Yes. So shares of rupees 2 lakh are given. But what we need to take is the fair market value as per rule 11 UA, which is 4 lakh. So I am taking the shares 4 lakh. What is my D? D is the land given, which is 6 lakh. The land given of rupees 2 lakh, but the SGB is 6 lakh. So I'm taking 6 lakh over here, which is for the land. I will take the stamp duty value. Yes. Now what about A? What about A? Yes, student. So FMV1, which is the fair market value of the capital asset transferred by way of the slump sale. Okay. FMV1 is the fair market value of the capital asset transferred by way of slump sale. So what will be my A? Yes, students, calculate at least that for me. Yes, faster. Yes, students, please let me know. What is A? Faster. What is A? B is 0. Yes, that I know. C is the shares which are transferred, which is 2 lakh, isn't it? The shares are transferred for 2 lakh rupees. D is the stamp duty value of the property, which is how much? Stamp duty value of property is 15 lakh, not 6 lakh. Sorry. Shares also is 2 lakh, not 4 lakh. 1 second. This is 2 lakh and this is 15 lakh. See, shares are 2 lakh and the SDV is 15 lakh. What is my A and L? Here, students, you are not giving me the answer. No one? Yes? Okay, so let me just give you the answer for A. In the A, what are we going to consider is the book value of the balance assets. Now, if you look at the balance assets which are there in the balance sheet, which are the balance assets that are given? So the balance assets are building we have already considered. So this 13 lakh which was there, of which we consider the stamp duty value of 15 lakh. Machinery, this we are going to consider. Then debtors, this is what we are going to consider. And the patents, this is what we are going to consider. As I said, IT refund will also be included. Shares we have already considered. So just write down in A, you have the book value of the assets, which is machinery 4 lakh. So machinery plus debtors. Debtors is how much? 2 lakh. Plus the patents which are transferred. So what does it say? The book value of all the other assets. So patents are for 2.5 lakh. Plus my IT refund. So IT refund will get included, which is 1 lakh. So this comes to how much? 6, 8.5 and 9.5 lakh. There is no unamortized expenditure or income tax paid that I could see. Yes. Is this correct? So what will be my FPC? So under A, you will add the income tax refund claim. So income tax paid is to be reduced, but from that, if there is any income tax refund claim, that needs to get added. So that I am adding it over here. Okay. Fine. Yes. So what is my A? A is 9.5. Fine. Next one is the L. What is going to be my L? The book value of all the liabilities. So what is L? At least tell me L if you're not telling me A. What is L, students? So L is going to be the share capital? No. Revaluation reserve? No. Bank loan? Yes. So in L, I will consider my bank loan of 3.2 lakh. Next is trade creditors of 87,500. Plus the payables of 50,000. Provision for tax I will not consider. So my L's total is going to be how much? Yes, L is going to total to how much? It's 3.2 lakh plus 50,000 plus 87,500. Right? So this is 4,57,500. Now FMV1 is going to be A plus B plus C plus D minus L. So basically this is 9.5 lakh plus 2 lakh plus 15 lakh minus 4,57,500. 21,92,500. Are we getting this answer? 21,92,500. Then what is my FMV2? My FMV2 is E plus F plus G plus H. What is my FMV2? E plus G plus F plus H, where E is the value of the monetary consideration that is received. F is the value of the non-monetary consideration received. Okay. So, E is, what do I receive as the monetary consideration? 10 lakh. F is the value of the shares. How many shares I have received? Value is 4 lakh. Gold, I did not receive any, so 0. And I have received the immobile property, which is 6 lakh. The stamp duty value is 6 lakh. So this is coming to 20 lakhs, isn't it? So in this case, what will be my higher amount? What will be my higher amount? Yes. Yes, students, please answer. So 20 lakh 92, 21 lakh 92,500 or 20 lakh, what is the higher amount? So obviously the higher amount is, out of the two, higher is 21,9500. So that is my FVC. Now coming to the cost of acquisition, the second part. This is my net worth, right? So for net worth, I have the book value of the assets. Now for the book value of the assets, what did the asset I have? Building. So 13 lakh is the book value, but there is a revaluation reserve is created by revising the value of building. The building is carried at WDV before making the revaluation. So, and then the SDV is given. So I will not consider, of course, the SDV. I will just consider the book value, ignoring the revaluation. So this is carried at WDV only, right? So the revaluation reserve I will reduce and I will assume that this is the WDV as per the Income Tax Act. We will write that this is assumed this is WDV as per Income Tax Act. So 13 lakh minus 5 lakh. First is building, 13 lakh minus 5 lakh. This is 8 lakh. I'll assume that WDV is as per ICAI because no other information is given. Then I will take machinery. So WDV of machinery is 3.5 lakh. It's a depreciable asset. So 3.5 lakh. Then debtors is 2 lakh. There's nothing said about debtors. So debtors, I'll take it at book value, which is 2 lakh. Patents are again depreciable asset. So 2.5 lakh, it is said patents are acquired on 1/7/2020 and are not depreciated ever. So I will calculate the WDV of patents. So 2.5 lakh minus depreciation for 2021, then depreciation for 21-22 and depreciation for 22-23 and depreciation for now 23-24. So for all these years, I will calculate the WDV of the patents. I cannot take the patents at the book value directly. Are we clear? So basically, here I will have to calculate the WDV How much are the patents for? Patents are for 2.5 lakh. So 2,50,000. Patents are depreciated at what rate? 25%. Right? The intangibles are depreciated for 25%. So how much it is coming to? 79,101. After 4 years, this is 79,101. The WD. Next is the income tax refund and shares that I will take it at the book value only. This is 1 lakh. Shares, this is 1 lakh. So total book value of the assets is going to be 8 lakh plus 3,50,000 plus 2 lakh plus 79,101 and plus 1 lakh and 1 lakh. So 16,29,101. 16,29,101 minus book value of liabilities. The book value of the liabilities is given, which is bank loan 3,20,000. Next is trade creditors 8,75,000. Payables, it is 50,000. So this is the book value of the liabilities that I have considered. So book value of assets minus the book value of the liabilities. That shall give me the answer. Right? So that is coming to how much? 12 lakh. So how much it is coming to? Minus 3,20,000 minus 8,75,000. Sorry, 87,500. It's not 8,75,000. It is 87,500. Here it is 10 less. And 50,000. 11,71,601. So basically, my net worth is 11,71,601. So my capital gain will be 2192,500 minus 11,71,601. How much it comes to? 10,20,900. Now this is long term or short term. It has been held for more than 36 months. So this is going to be long term capital gain. This is going to be my long term capital gain, which shall be taxable at 20%. So this is long term capital gain tax at the rate of. Yes, students, have you understood? Yes? Yes or no? Fine. So with this, we finish off the reorganization. Now in the next class, what is remaining is section 48, which is the computation. And then we go to 50C, 50CA and 50D, the special provision. Then we go to 111A, 112, 112A, which is forming the tax rates. And finally, the 54 series, which is what we are going to consider. Fine. So we are done with almost majority of the capital gain topic. If you look at it, we are now left with the balance section, which is the 54 series and then the tax rates which shall follow. Fine. Rest are the smaller provisions, which we will finish it off very quickly, which is not major, only is then 112A, 112 and the 111A, the tax rates that we are going to discuss in the coming class. Fine. Viraj, what is wrong with FMB1? What is the problem? In case you have any question, you can just go through and we can discuss in the next class also, Viraj. There's not an issue. In case there's some calculation mistake, you can just let me know. Okay? Yes or no, students? At least give some answer. Why the enthusiasm has gone down? Yes. Yes, students. Yes or no? Have you followed this slum sale? Yes. Viraj, I am getting a total of 2190 to 500 only. My total is not coming to 3107. It is coming to 21,92,500. It is A plus B plus C plus D minus L. How come you are getting 31.07? You can just recheck once and we can of course discuss in the next class. Okay? Yes. So we can just stop here for today and we can meet in the next class. But I'll suggest please revise and please be participative. Okay? Thank you so much. See you in the next class. We can close the session.